Hello everyone. Welcome to yet another exciting session where we talk about stocks, direct equities, commodities, and much more. I am Sonam Punjabi from Tata Capital Moneyfy, and I'll be delighted to guide you through today's discussion. Before we jump into the insightful session, I have some fantastic news to share. All our Moneyfy users can now invest in stocks, IPOs, FNOs, commodities, and much more directly on the platform. Before we get into the good stuff, I'm absolutely thrilled to welcome today's special guest, the founder of Raise Financial Services himself, Mr. Jay Prakash Gupta. And we're glad to have you today, Jay. Thank you for joining.
Yeah, thank you so much, Sonam, and it's a privilege to be one of the guests at your webinar. I'm pretty excited if I can share something of value with your audience.
Superb, superb. So जय let's kickstart and बहुत सारे हमारे जो मनीफाई के यूजर्स हैं राइट देर आइदर ट्रेडिंग इन बैंक निफ्टीज या स्टॉक्स में भी ट्रेड करते हैं तो किस तरीके से कमोडिटी मार्केट डिफर्स फ्रॉम से एन इक्विटी मार्केट and are there any ways to identify any trends in commodity markets if you can throw some light on that?
Well, Sonam, just I'd like to take you थोड़ा सा मैं background देना चाहूँगा. See, commodities market is prevalent in India, way before the equities market started picking up. India mostly is a
Yeah.
commodity, dominated country. So आप कहीं भी देखो, people are aware about the commodity prices, be it on the agri side, be it on gold and silver. हम हाउस होल्ड में भी हम किसी में बात करें तो घर पे सबको पता होता है कि गोल्ड का रेट क्या चल रहा है. No, so that's
Correct.
on the physical side of the market. So when it comes to exchange traded, commodities, see, exchange traded commodities grew in early 2000 in India. When exchanges like MCX and NCDX got established. So when you have exchange traded commodities, there are certain contracts which are available or certain classification of commodities which are available for trading. तो broadly अगर हम देखें तो see we can categorize it as bullion is one category. तो bullion के अंदर gold, silver, platinum आता है. Then there is another category of base metals. So base metals में you have commodities like copper, lead, zinc, aluminium which are traded. Then there is another segment or which is called energy, which is very much in news nowadays because of things going on in Israel and Iran and Russia-Ukraine war, which
Yeah.
is which comprise of crude oil and natural gas. Apart from these are mostly international traded commodities. There is also a fourth segment, or which is of agri commodities. So in agri commodities, you have commodities like mentha, cardamom, and commodities also like turmeric, which is available on NCDX. So broadly, these are the four categories on and the types of commodities which are traded on exchanges. Now, how
All
it's
right.
different from equities market is, see, when you invest in
Yeah.
equities, what you do is you get an ownership of a company through shares. Okay, so the
Correct.
shares are in paper form. You hold it in a demat form. The advantage with commodities is,
Yeah.
commodities are physical assets, okay, which you can touch and feel, right? So if you buy gold,
Yeah.
and take a delivery, you can feel it's a tangible asset, okay. And
Yeah.
another important thing which differentiates commodity market from equity market is the demand and supply factor. Mostly commodities markets are governed by the demand and supply. The
Absolutely.
jargons like a company's EPS, company's price earnings multiple, a company's debt
Hmm.
equity ratio doesn't come into play. Okay, so relatively understanding commodities is easier, as we have seen in the past as well. If even a farmer understands how the price of commodities move based on how the acreage is going to be, how the sowing happened, how the harvesting looks like, because they understand if there is large supply, the prices are likely to be down because there is excess supply available. When there is shortage of demand, or sorry, shortage of supply, that means the prices is likely to shot up. So there are a lot of
Yeah.
factors which govern commodities market. Predominantly, it's demand and supply. Even in cases of crude oil, when we hear about that there is some kind of war-like scenario between Israel and Iran,
Yeah.
there is an assumption that the supply of crude can get disrupted. Okay, and that
Yeah.
leads to a surge in crude oil prices. Or
Yeah.
if there is any war-like situation, okay, people rush to buy gold because they feel that if something goes wrong, the gold becomes a safe haven buying.
Yeah.
So you can easily ascertain the demand supply part of it, and there are enough of data available, okay, in
Hmm.
public domain, which can give you an idea about how things are shaping up, how the demand and supply is likely to be. So that's the second point. Third important point in terms of different, how it's different from equities market is the timing. Equity
Yeah.
markets usually starts at 9:15 in India, and it's till
Yeah.
3:30, while
Yeah.
commodity markets on exchange traded commodities, it starts at 9 a.m. in the morning, and the market is open till 11:30 at night,
All
and
right.
during winters it's even till 11:55 at night. So
All
it's a
right.
long 14-15 hours market. Okay,
Yeah.
so and this commodity markets are more linked to what's happening in international markets. Okay, it is very sensitive to events which is happening globally. Now,
Hmm.
say if in the evening, if there is some news which comes from Europe, or there is some data which is released in US, say says that US GDP is not doing well. Okay, it will have a direct impact on commodities. So
Yeah.
these are the few things which one can keep in mind while differentiating between commodities and equities.
Yeah, pretty insightful. Like you mentioned, basic raw materials like gold, silver, coffee, or even wheat, all of these are traded. And the best part is that it is traded all over the world.
True.
So pretty interesting, Jay. Just slightly zooming in, and wanted to know where all the action happens, the commodity exchanges. So for someone who's new to trading, can you explain us a bit about what a commodity exchange is, how it works, why is it important part of our process, because I'm sure a lot of our viewers are wondering where all the buying and selling actually takes place.
Well, Sonam, it's when we talk about commodities exchanges, like we have NSE and BSE on the equity side, there are two major exchanges on commodities side in India. One is MCX and the other is NCDX. By MCX, it's Multi Commodity Exchange, and NCDX stands for National Commodity Derivative Exchange. So,
All right.
when the kind of commodities which gets traded in both the exchanges, NCDX predominantly has more of agri contracts, while MCX has a little bit of agri contracts, but it's more known for international traded commodities. Like I mentioned while answering the previous question, that there are broadly three categories or four categories rather: bullion, base metals, energy, and agri. So all these four segments are traded on MCX. Now, recently, regulator has also allowed NSE to also get into commodities. Now, NSE also has a commodity segment which works in the same lines of with MCX, where the market hours are from 9 a.m. in the morning till 11:30, and during winters till 11:55. So now you have three exchanges effectively in India, which provide opportunity for any investor or trader to trade in commodities: MCX, NCDX, and NSE. Yeah.
Yeah. Understood, understood. So just Jay, one more aspect which is very important, right? That there are just two most common ways in which trade of commodities happens, either futures or options, right? But it can be a little tricky for our investors to wrap their head around it. Can you break it down for us, the difference between futures and options in simple terms, or maybe just give us some real world commodity trade examples to understand this better?
Well, Sonam, see, the definition of futures and options remains the same, whether it's equity derivatives or commodity derivatives. So,
All
by
right.
definition, if you go in simple terms, futures or derivatives are instruments whose value is determined by the value of the underlying. Okay. Now, in equity derivatives, the underlying is some stock, okay, or the indices. So take for example, if you trade in Nifty futures, okay, the underlying is the Nifty index. Okay, so
Correct.
the derivatives of Nifty index is your index or Nifty futures. Similarly, for a gold futures, the underlying is the gold price. Okay, so the
Understood.
futures usually has the same correlation, the positive correlation with the underlying price. So, say for example, if today on in the spot market, or if you go to a jeweler, or if you check with your bank, if the gold per 10 gram is say 80,000 rupees, the futures of gold will be slightly higher than 80,000 rupees, but it moves in the same direction. If the spot price go up, the future price will also go up. Okay,
All
now the
right.
difference or the interesting part about derivatives is that derivatives gives you the leverage. When I mean by leverage, say for example, you want to buy 100 grams of gold. Okay, at today's rate, if you go and buy this 100 grams of gold from any means, from a jeweler or from your bank, you have to pay 8 lakh of rupees. If I assume
Absolutely. Yeah.
80,000 rupees per 10-gram rate.
10 grams.
Now, the futures give you that advantage that you can have an exposure to same 100 grams of gold by not paying 8 lakh rupees upfront,
All
because when
right.
you trade in futures, you get an advantage from the exchange, which is also called the margin money.
Mm-hmm.
Now, assuming your margin money is say 10,000 rupees, 10%, so you can have an exposure of 100 grams of gold by buying one lot of futures by just paying 10% as margin, which comes to
All right.
80,000 rupees.
Hmm.
Okay, so imagine the kind of leverage you are getting, and if you are buying futures for a purpose of let's take an example that somebody wants to buy 100 grams of gold for a marriage purpose. Okay,
Hmm.
and the marriage is after 6 months, and the person feels that okay, I do not want to put 8 lakh rupees today, but eventually I will take the delivery of 100 grams of gold after 6 months, and I'll be paying their futures contract is going to help you tremendously. Because if you buy gold today from a jeweler, okay, you have to pay, first is you have
Yeah.
to pay 8 lakh of rupees upfront. Second, you have to also manage the storage of the gold, because once you have bought the gold, you either put it in a locker or you keep it somewhere else. Okay, there is a cost attached to it. Okay, there is
Yeah.
also a risk of storage there. Now, what happens in futures? You bought 100 grams of gold ka future, okay, which is also typically called gold mini contract in futures. So you pay 10% upfront margin,
All
and
right.
you buy a contract which is expiring after 6 months. Now, for next 6 months, you save your capital, because your capital is not getting deployed. The
Hmm.
contract exposure of 8 lakhs you are holding just by paying 80,000 rupees. So
Yeah.
7.2 lakh of capital which you have, you can either fix deposit it and earn some money out of it.
Yeah.
One, when after 6 months, when your contract is expiring, you tell exchange or you tell your broker that hey, I want to take the delivery of my 100 grams of gold, and your futures gets converted, and you take delivery of gold. So what happens is you get gold which is tamper proof. You have authenticity of the gold because it's coming directly from the vault of the exchange. Okay, you the purity is guaranteed. You save on your capital because you could have used that money somewhere else, and
Yeah.
you don't run a risk of storage.
Yeah.
This is how a futures contract, if used effectively,
Yeah.
can give you an opportunity to plan your finances accordingly.
Yeah.
Right. Now, just to explain in simple terms how options work is, we discussed about two modes of buying any asset. Say we were taking an example of gold. Either you
Yeah.
pay 100% money, you buy gold in physical quantity, take a physical gold, right? Second is you use it through options. The third category is you buy it or you get an exposure through options. See, options help someone whose
Mm-hmm.
ultimate aim is not to take delivery of gold, but to take advantage of the price movements happening. And
Correct.
somebody wants to, risk a very limited amount of capital. I'll explain you how it works.
Sure.
Say, same example, 80,000 is gold today. You
Yeah.
feel that, okay, the times are uncertain, or some of your financial advisor had advised you that the gold is likely to become 85,000 rupees,
Hmm.
and you want to take a exposure in it. Okay, what you do is you go and check 80,000 gold, what, or say if it's likely to become 85,000 in next 3 months. Okay, so you take an exposure by buying a call option of
Okay.
gold, okay, by paying a small premium amount.
Mm-hmm.
So when you go on the exchange platform, or when you go on Dhan, okay, and you type gold options, say contract expiring 3 months from now. So we are in November, so says the contract expiring in February. You go and check that 85,000 call option, and the premium which say assuming that the premium which is quoted there is 100 rupees. Okay. Now, to buy one lot of gold mini option, you have to pay only 1,000 rupees because
All
100
right.
rupees is the premium, and the rate being quoted is of 10 grams. So for 100 grams, you have to multiply it by 10. So just by paying 1,000 rupees, you are entering into a contract where you are capping your losses, because what happens if the gold doesn't go to 85,000 rupees, and if it remains at 80,000, or if it falls to 78,000, the maximum amount you lose is only 1,000 rupees which you paid as premium.
Yeah.
But what if gold starts moving up as per your financial advisor who advised you, and gold becomes 85,000 rupees? So your premium value of 100 rupees is likely to go up. I assume that it becomes 200 rupees
All right.
after 3 months. So at that time, what you do, that my investment was 1,000 rupees, but now what I am realizing is 2,000 rupees. Okay, so I'll
Hmm.
book my profits and exit. Okay, so imagine the kind of return you have earned here. By investing just 1,000 rupees, you have doubled your capital.
Yeah.
Yeah. And if the things would have gone wrong, the maximum you would have lost is only 1,000 rupees.
1,000 rupees.
So that's how options are being used by traders or people who have short-term objectives, who want to play certain directions. This is a very basic thing, but there are a lot of strategies which can be created using
Correct.
options, but that's for another day. To put it
Yeah.
in simple terms for a layman, this is how it works. So futures gives you that advantage of saving your capital. With lesser capital, you can have an exposure and you can meet your ultimate objective of taking delivery of gold.
Yeah.
If you really want to play a directional movement in any prices, be it gold, silver, or equities, you can use options to do that. And how it's going to help? It's going to cap your downside by the premium which you are paying, and your upside becomes unlimited.
Pretty interesting, Jay. In fact, Very insightful details that you shared about futures and options, and I'd urge all our viewers to watch another commodities webinar that we've done with Dhan team, where we've given a walkthrough of the entire dashboard, where there is just plethora of data available, very comprehensive dashboards for you to explore. And little bit zooming in further on gold and silver itself, Jay, in the context, in Indian context, right? India is one of the largest consumers of both metals, gold
Yeah.
as well as silver.
Mm.
How does gold and silver market actually work in India? What are the factors that are driving the prices, right? Say there are government policies or festivals also for that matter, or even changes in global markets that impact the prices of these metals. So if you can just slightly zoom in a bit more on just gold and silver metals for us.
Interesting question, Sonam. See, gold and silver, the factors which determine gold and silver prices are mostly common across the globe. You know,
All right.
as I told earlier as well, that gold gives you that safe haven. Whenever there is uncertainty, we have seen historically that gold has always come to the rescue. Okay,
Yeah.
so the factors which drive, I'll start with gold first and then I'll come to silver. The factors which drive predominantly, the factors are, one is the uncertain scenarios. Okay, whenever you see that war-like situations happening, the economy is going under crisis, okay, you will always see that people sell off equities because those are
Yeah.
riskier assets, and they try to rush to something which is more secure. So gold comes on the top in that list. Okay, so the factor one is that. Second is if there is any inflation in the economy, what happens when there is inflation is that your purchasing power of your currency goes down.
Yeah.
Okay, so with more amount of money, you will be able to buy lesser amount of goods. So gold acts as a hedge against inflation. Okay, so because the gold value, the purchasing power of gold doesn't go down. So that's again another factor. Third, short-term factor can be, a demand coming from the central banks of the country. Now there is a lot of talks around that, some of the countries want to de-dollarize themselves and want to
Yeah.
launch their own currencies. We have seen in the recent past that central banks of China and Russia,
China
even
has been doing
India,
that. Yeah.
okay, they were buying gold. So gold is a limited, commodity. It's not available in abundance. Whenever there is higher demand for gold from central bankers, the prices tend to move up. Okay, so these are the factors which mostly govern the gold prices. Uh, Another short-term seasonal factors could be the marriage season in India.
Yeah.
Okay, or festive seasons like in Dhanteras there is gold buying which happens, but these seasonalities doesn't impact gold prices much. You can have some slight movements coming in, but broadly it's like the inflation, buying from the central bank, and any uncertain environment about the country or about an economy that affects the price. Now coming to silver, silver also has the same quality as of gold because it both comes under the bullion category. Uh, Apart from the three reasons which I cited, there is another interesting development which is happening on the silver side. Is the demand for silver is also coming from new age businesses.
Yeah.
We are globally there is a lot of concern about climate, so we are moving towards solar energy where we are trying to adapt renewable sources of energy. Okay, so there solar panels require silver.
A lot
Okay,
of silver.
yeah, the electric vehicles, the battery in that the solar is required. Okay, so these are driving. So the new age demand, okay, which is more conducive towards climate, is creating more demand for silver. The industrial usage, once it starts going up, we use cell phones. There is silver which is used in cell phones.
Yeah.
Okay, and then the semiconductor, the chip industry which is growing, that has demand for silver. So as long as this demand is likely to grow, silver prices will is also likely to grow, because again silver is also has got a limited supply. You cannot just produce it overnight. Okay, so these are few factors which one should be watchful when they want to get into any kind of investment or trading in gold and silver.
Pretty interesting, Jay. So moving just slightly further on this itself, can you give us an overview of what is a bullion and how does it differ, say, from other forms of gold and silver, like say jewelry or coins that typically people end up buying, and especially during economic downturns or uncertainties, like you mentioned, people rush towards these metals. Uh, One more question that we have for you is, what should a trader be aware of when they're considering investing in or trading in a bullion?
See, I'll come to the your first question. First part of the
Yeah,
question is like
yeah,
bullion and jewelry. See, anything which
yes,
is in their original form, okay, be it
yes,
gold bars, gold coins, okay, which are not meant for uh, any other purpose, right? Apart from your investing. So when you buy a gold bar, you don't wear it.
yeah.
You either keep it somewhere. So that forms part of bullion. Whenever you change its dimensions, or you change the original quality of it and use it for your consumption purpose, that becomes jewelry.
Hmm.
Okay, so that's one. Second part is how a trader should take advantage of it. Is that, see, there are two ways of analyzing and using the price movements to your advantage. Okay, one is understanding the fundamentals part of it and understanding the technicals part of it. Okay, when you use technicals, you use various parameters on the chart to understand the short term movements or where the supports and resistance are. So it's a different study altogether. I think many of your users might be aware how to use charts. If not, there's a lot of information and content available on Dhan's where on Dhan, where somebody can go and learn about it. Coming to fundamentals, a trader or investor should be aware of what's happening around the globe. Okay, some of the key economies which affect the price of gold and silver are obviously the large economies and developed economies like US, China, anything happening in Middle East, European countries, and then India.
Yeah.
Okay, India, though is the largest consumer of gold, is not a price setter yet. Okay, so when you track US economy, what are the things you should look into? You should look into the unemployment numbers, which come every Friday of the month. The data is
All right.
published by US department. The government publishes it. You come to know what's the employment number there, whether the employment rate is going up, going down. That has again a short-term impact, because that has a sentimental impact. If all of a sudden you hear that the unemployment rate in US is going up, it's an indication that the economy is not did not do well in the past month. So that creates short-term concern, and the gold prices starts moving up. Okay, then there are GDP numbers which come from US, Eurozone, and China. Okay, that again gives an signal whether the GDP has improved or it has not improved. That has impact on gold. Third is the news related to geopolitical concerns.
Yeah.
Okay, any war-like situation is happening, one should be mindful of it and take positions accordingly. So understanding the fundamental data and using it by studying technicals is a very good combination. If you see that okay, there is some GDP number which has come bad, and you want to see the impact of it, you can use certain tools on the charts and see that where the resistance and support lies, and accordingly you can initiate your trade.
So basically taking the macro economic view and then zooming into the trading strategy.
Exactly.
All right. So I'll not trouble you further, Jed. Just one last question,
Yeah.
because a lot of our viewers are beginners in trading, and how can they start trading in commodities?
Well, that's a very nice question, Sonam. See, the first thing you need to understand is you are new to markets. Do not over leverage when you are new to markets, be it in commodities market or any form of financial market you get into. Okay, start small, start with a very limited amount of capital, do the water testing. See, you have to start in commodities which you understand well. Okay, for Indians, the most active commodity which we all understand is gold, because gold is something where every household is aware about how the gold prices are moving up or moving down. You may not be aware about any other stock prices, but you ask anyone at your home, some of them might be aware about the gold prices. So various
Absolutely.
kinds of gold contracts are available on exchanges. So you have 1 kg contract, you have 100 grams contract, you have gold guinea which is 8 grams contract, you have 1 gram contract which is gold petal.
Better.
I would suggest that start with a smaller amount.
Hmm.
uh, you can start with either 8 grams of gold, see how the price moves, because just to enter into a contract you don't require a large capital. Start small. Once you have a contract, you will try to find out the reasons why the price are moving up and down. Use various tools. You will try to go and find out from various sources of information, like why the prices are moving up. So that gives you an idea. Once you get a hang of it, once you start becoming confident, I think gradually you can move to options. Start with mini options, because that's again gives you an advantage, because a very limited amount is involved. The risks are also limited. That's how you need to start, right? Once you
Yes.
gain confidence, then probably you can increase your bets, get into a larger contracts. And well, gold and silver gives you a very good hedge against your existing portfolios as well. Because if you are holding certain stocks, you have certain stocks in your portfolio, and you feel that things are looking uncertain, you can always shift some amount in gold, because gold also acts as
Absolutely.
a becomes gives an anchoring effect to your portfolio. So that's how you should start, and keep looking for informations. There are ample of informations available on Dhan. Your Moneyfy YouTube channel also provides a lot of insightful informations. So they should be watching it and managing their risk. That's very important.
Even from a diversification point of view, they can take a
True.
small
Yes.
exposure.
Yeah.
Thank you. Thank you so much, Jay. That brings us to the end of our session now. I think it's been a fantastic discussion. I believe from beginners to even avid investors and traders will find this session very insightful. So, thank you for coming and taking time out and sharing your expertise on the matter today.
Thanks, Sonam. It's my pleasure. Thank you so much.
Thank you. And thanks to all the viewers watching. Hope you found this session valuable. It's a wrap for the commodity trading webinar now, and I hope it adds value to each one of you. And remember, commodities are fascinating world. And like Jay said, that keep learning, stay curious, and never trade more than you can afford to lose. So thank you for joining and happy trading. We'll see you on the next one.